state pensioners warned over double tax of 67% in major HMRC rule change. Are you retired or close to it? You could be paying up to 67% tax on your pension and not even know it. A major HMRC rule change is hitting thousands of UK pensioners with double taxation, draining retirement savings faster than anyone expected. In this video, I'll break down exactly what's happening, who's at risk, and how to make sure it doesn't happen to you. So what's really going on here? Why are pensioners suddenly facing the risk of what's being called double taxation, and how has this 67% figure come into play? Welcome to UK Pension Update, your trusted source for the latest news, changes, and expert insights on pensions, benefits, and retirement in the UK. If you're retired or planning for it, we've got you covered. Let's dive into today's important update. To understand this unfolding issue, we need to take a closer look at how pensions are taxed in the UK and how a combination of new tax rules, rising thresholds, and inflation is pushing some retirees into a dangerous tax trap. In the UK, the state pension is taxable. Yes, that surprises many people, but it's true. Even though you don't pay national insurance once you reach retirement age, you still pay income tax if your total income exceeds the personal allowance. Currently, the standard personal allowance is £12,570 frozen until 2028 under the government's fiscal drag policy. That means any income you receive above that threshold, including your state pension, workplace pension, annuities, or even rental income, is subject to income tax. Here's where things start to get complicated. Most people assume their workplace pension is the only income they'll need to monitor. But when your state pension is automatically added on top, you can quickly find yourself exceeding the tax-free threshold, especially now that the new state pension is worth over £11,500 a year and continues to rise with the triple lock guarantee. The triple lock, as many of you know, ensures that the state pension increases each year by the highest of three measures: inflation, average wage growth, or 2.5%. On the surface, that sounds like a win for pensioners, and in many ways, it is. But with inflation hitting record highs and earnings rising sharply, the state pension has grown faster than many expected. So now, thousands of pensioners who once fell below the tax line are being pushed into the taxable income bracket, often without realizing it. But here's the real kicker. The way HMRC applies taxation on multiple income sources can sometimes lead to overlapping tax calculations, especially if your employer's pension provider or private pension scheme doesn't correctly account for your state pension when deducting tax. This can result in tax being deducted twice on the same portion of income, hence the term double tax. For example, imagine you receive £11,500 a year from the state pension and an additional £6,000 from a small private pension. That totals £17,500 for £1,930 above your personal allowance. In theory, you should only pay tax on that £4,930. But if HMRC hasn't correctly allocated your personal allowance across both income sources, or if your private pension is taxed on the assumption that you have no other income, you could end up paying 20% tax on the full £6,000 from the private pension without any allowance. Add to that the tax due on your state pension income, and suddenly you're being taxed on more than you should be. In some reported cases, the effective tax rate on small pension withdrawals has been as high as 67%, due to the combination of incorrect tax codes and the automatic application of emergency tax rates, especially when people take lump sums or flexible withdrawals under pension freedoms. This is what has triggered alarm bells. Retirees are being caught out by emergency tax codes, which are often applied by default when pension providers don't receive up-to-date tax instructions from HMRC. These codes can cause one-off withdrawals to be treated as if they're monthly or regular income, pushing people into much higher tax brackets than they should be in. To make matters worse, many pensioners don't even realize it's happening until months later, often when they receive a P800 reconciliation notice from HMRC or notice their pension income seems unusually low. By then, it can take weeks, even months, to reclaim the overpaid tax. This is partly the result of fiscal drag, a stealthy form of taxation where the government freezes thresholds, such as the personal allowance or higher rate income tax limit, while inflation and wages rise. As pensions and incomes increase naturally over time, more people are pulled into paying tax even if their real spending power hasn't changed. This is exactly what's playing out right now in the UK. With the personal allowance frozen until 2028, but the state pension continuing to rise, many pensioners are being dragged over the threshold and taxed sometimes for the first time in decades. And it doesn't end there. Pension freedoms introduced in 2015 have allowed retirees to access their pension pots more flexibly. But while flexibility sounds like a good thing, the tax rules around withdrawals are extremely complex. Taking a large lump sum in a single tax year, for example, can trigger a massive one-off tax bill because HMRC assumes you'll receive that same income every month and taxes it accordingly. Unless you manually claim the overpaid tax back, you're left footing the bill. Let's take a real-world example. Suppose someone draws £20,000 from their pension pot to fund a home renovation or cover medical expenses. Under emergency tax rules, HMRC may tax that entire £20,000 as if it's monthly income, projecting an annual income of £240,000. The result? A massive upfront tax deduction, sometimes as high as £5,000 or more, even though that person's total annual income may only be £25,000. It's only through a refund request, usually via Form 55, P53Z or P50Z, that they can claw back the overpayment. But many don't know these forms exist. This is where the new warnings come into play. Pension experts and tax advisors are now urging retirees and those approaching retirement to take a proactive role in managing their tax exposure. That means checking your tax code regularly, understanding how your income sources interact, and avoiding large one-off withdrawals without calculating the tax implications. And don't assume HMRC will automatically fix the problem. While they do issue refunds, the process can be slow, and errors can go unnoticed for years, particularly if you don't file a self-assessment tax return. Another group particularly at risk are those with small pension pots who are taking advantage of the small pot rule, which allows individuals to withdraw pensions of £10,000 or less without triggering the money purchase annual allowance. These withdrawals are also vulnerable to emergency tax codes again, leading to a situation where up to 67% of the withdrawn amount gets swallowed by tax, even when the individual's total income is well below the threshold. First, check your tax code regularly. If you're receiving multiple pensions or income streams, make sure your personal allowance is allocated properly across them. If it's not, you could be overpaying tax every month. Second, spread withdrawals where possible. Instead of taking one large lump sum, consider splitting it across tax years to avoid triggering higher brackets or emergency codes. Third, use HMRC's refund forms if you believe you've overpaid. The forms you'll need depend on the situation: P55 for people who've made flexible withdrawals but aren't taking their entire pot, P53Z for those who've withdrawn their whole pot and have other income, and P50Z if you've withdrawn your whole pot and have no other income. And lastly, consider speaking with a tax advisor or independent financial planner before making big decisions. Yes, it costs money up front, but the savings in tax could be many times greater. The key message here is simple: don't sleepwalk into retirement thinking the system will handle everything for you. The UK tax system is not only complex, it's also increasingly catching people out. With thresholds frozen and pensions rising, more retirees than ever are being taxed, and in some cases, overtaxed without understanding why. A double tax hit of up to 67% is not just an accounting glitch, it's a financial disaster for those on fixed incomes. But it's preventable if you know what to look for and take action early. Thanks for watching UK Pension Update. If you found this helpful, give it a like, subscribe, and turn on the notification bell so you never miss a critical update that could affect your finances. Stay informed, stay prepared, and we'll see you in the next video.